everyone, welcome back to another True Potential Do More With Your Money podcast. It's episode 167 this week, and it's going to be an interesting one because it is actually about interest rates, because again they went up this week, as you probably saw in the news. So we're going to talk about that today and see what it means for you. I'm joined on the podcast this week by Paul Durrance, George Bellsback and Neil Rayner. Becoming an ever-present Neil on the podcast.
Yeah, familiar face.
A familiar tie. I see you and George have been to the same shop pretty much. You almost have identical ties.
We got 2 for 1.
Well, it's always. I'm not surprised by that, because I know you like to save a few pounds of other people's money.
We're known as the Maxim Paddy of the retail world.
Are you really?
Yes, we are.
Who's who?
Have a guess. Decide. Let the audience decide.
You're being too funny. It's too early in the podcast. Save it for later. So interest rates this week. It's been probably the major economic news of the week, and then there's a lot of stuff lying behind that to do with inflation and what's happening in the US and Europe and all the rest of it. So we're going to talk about that. We're going to get into the ribs of some of that this week, I think, Neil. And a shout out to Daniel and Greg for that one as well, but we'll come back to that maybe another time. I hope not. I just want to come to you first if I can, Paul. That's an in-joke that if you didn't watch last week's podcast you wouldn't understand, so you'll have to go back and watch it. I want to just, for anyone who perhaps missed the news, if you've been out on the road this week or been away with work or whatever it is, you might not have caught up with interest rates. So what happened this week, Paul?
So yesterday we saw the Bank of England raise interest rates by 0.25%. So going from a base rate of 4.25 to 4.5. Now this was very much expected by the market, very little reaction from the market following it. And the reason why they're putting up interest rates is because inflation is still very, very high. So the Bank of England target inflation at 2%, currently got inflation at 10.1%. So that is very high, but we do expect it to fall quite significantly over the next couple of months and throughout the rest of the year, as does the Bank of England. But they put up interest rates. The 9-committee voting team voted 7-2 in favour of doing so. The market's expecting interest rates to go to 4.75, so another interest rate hike expected. But then the market believes that they'll be done because inflation is coming down. So we are at a 15-year high.
I was going to say that 4.5%. When you put it in context, as you say, it's the highest for 15 years. I mean, these are historically. I know people will know if interest rates have been in double digits in the past. Yeah. So we're not talking record highs, but certainly in the last 10 to 15 years, this is new territory.
Exactly. So coming out of the financial crisis in 2008 to 2009, central banks around the world pushed interest rates to very, very low levels, like 0.25%. And it's just because of the inflation backdrop that we've had over the last couple of years coming out of COVID that they've had to be very aggressive in raising interest rates. So if we went back just 12 months ago, interest rates were at 0.75%, so we're now at 4.5%, so big change. And what they're trying to do is bring inflation down by stifling demand. So as expected. But
you mentioned there, just out of interest, the is it the Monetary Policy Committee that makes these decisions? The 7-2, the vote 7-2.
Yeah.
Do you ever find out the two that didn't want this? Is that because they wanted to go higher, or did they just not want to rise at all? Do you find that out? Or?
Yeah, they do publish what each member votes for.
Right.
The two that voted against, they actually wanted to leave interest rates unchanged.
Where they were, right,
because interest rates have already gone up really aggressively over a very short space of time, and it typically takes many months for that to work through the system. People take out mortgages.
Yeah.
If you're on a fixed mortgage, then it takes time before you have to remortgage, and it'll take time before that higher interest rate that you're paying on your mortgage will actually take in.
I was going to say, Neil, we're talking about 4.25% to 4.5%. Doesn't sound like much in the grand scheme of things, 0.25% rise, but this is adding hundreds of pounds a month onto people's borrowing costs, mortgages, and other things. I mean, how else might people be feeling that right now?
Yeah, they're feeling it. I walked past a newspaper yesterday, and it was something like the average mortgage payments annually are going up by £7,000, which is a considerable amount when you think in terms of income, your average income, and that sort of stuff. So people are definitely feeling the mortgage rises. People in their older generations are obviously having a look because savings rates have gone up as well.
Yeah.
I think if you're taking a few sort of big high street banks, and they're putting up maybe fixed rates where you're putting your money away for 1 or 2 years, and also big American players like Chase are putting in 3% bank accounts. So on the one side, a lot of people are making money in a bit in their savings, but also as well, a lot of people are facing really heavy penalties when they're paying their mortgage off. But as we know, this may be a short-term thing from an interest rate point of view. So you could be attracted by that.
Yeah.
But if we have a look at things like the portfolios, where we are looking over the medium to long term, that's something that you would definitely consider.
Yeah, because I mean, 4%. If you might get a bank account that gives you 3 or 4% now, so savers are the winners out of what's a fairly bleak situation in general, but still not getting anywhere near inflation if inflation's at 10. And correct. George, why is inflation's? We've mentioned it's coming down. We talked on one of the podcasts recently about how it's not coming down quite as quickly as, say, the Bank of England was hoping. We were hoping to be below 10% now, but it's still, as Paul says, around about the 10.1% mark. Why is it not coming down as quick? Because it is in other parts of the world, isn't it? Give us a bit of context.
Yeah, it is. I mean, in the UK, a lot of it's driven by the strength of the consumer. Of the consumer, because you've got such a low level of unemployment. Essentially, companies have had such a hard time of attracting and retaining workers over the last 2 years after the pandemic, when we did have that demand surge, that it's actually leading to wage growth, which has been coming through, which puts the consumer on a better footing to, one, navigate the fact that prices are higher, but also just maintain that appetite to get out there and spend. And we have seen a shift in terms of people moving from buying a lot of goods, because they bought them all in 2020 when they were stuck in the house, to services and experiences, restaurants, bars, professional services, and so on. So that's driving a lot of the inflation aspects that we're seeing. Paul mentioned there's been a significant amount of interest rate hikes come through over the last 12 to 14 months, and it takes time for those to have an effect. So, we have seen, as well as around the world, central banks starting to think about pausing on the interest rate hiking cycle. We have in recent meetings seen a moderation in the size of increases as well, because they're data dependent, and they're waiting to see what impact this all has. If we look at areas like the US, essentially what we're seeing is inflation, which is, there's various different ways you can look at inflation to get a different reading of the drivers. If we look at what's happening month over month, if we just take April in the US, we had reports this week that showed inflation was going up 0.4%. Now that's double the rate the Federal Reserve needed to be in order to bring inflation towards that 2% target. And if we look at the components which are driving that, we've talked about mortgage costs, rental costs, which we capture in shelter, have been putting upward pressure there. You've also seen food prices in there as well. Areas which have been bringing the inflation reading down is areas like energy. So if we look at energy year over year, that was down about 5% in the US. If you break that basket open, there's various different components. Petrol prices down about 12%, heating oil and diesel down around 20%. So you have got these different aspects which are taking hold. But in the US, of that inflation print that came out for the year-over-year reading, it was encouraging. It was 4.9. It's down from 9.1 at its height in the summer. But services are still 80% of that print. So it's still having a massive driver. But if you take those components out, being food, being energy, why would you take them out? Because they're more volatile, because there's more seasonality attributed. That's where the challenge lies, and it lies there because if we look at headline inflation year over year to the end of April, 4.9%, the direction travel's been encouraging. But if you look at core, where services is a bigger component, that was actually remaining stubborn, so it's higher. That's at 5.5% at this point in time. And that's the challenge for the Federal Reserve. It's not coming down as quickly as what they expected. But where they go from here is, essentially we've seen like the UK, we've seen 4.75% worth of interest rate hikes in 14 months come through, and we now believe that the Federal Reserve are going to take stock. They're going to pause on that interest rate hiking cycle. No guarantee there, because we'll wait to see what the data tells us.
I read something similar in the UK, that some of the experts believe that we may be at the end now of these interest rate rises. Absolutely. Maybe there's another 0.25% to come, maybe one more, who knows? But certainly we think we've done the hard yards. Is that not right?
I think that's absolutely right, and the market's only expecting rates to go up maybe once or twice, 0.25% increases, because they're expecting inflation to fall. It's very high now, but because of base effects, because of mathematically how it works, as you progress through time, your measuring point is going from a high point to a lower point, and so inflation will naturally come down, and it should. So if we look at what the Bank of England are expecting, so by midsummer, UK inflation to be at 7, by the Q4 down at 5, this time next year down at 3.5. So that's a material deceleration in inflation, and that means that interest rates are expected to come down. So when we think about cash rates at the minute, yes, you might be able to get 4. I mean, you do well to get 4.5%, but around 3% may be attractive to investors, but that won't necessarily stay there for a long time.
Well, I was going to say, do you think interest rates will come down? Let's say what the talk is correct, and inflation does come down to this time next year. We're back to any of that target of 2%. Do you think interest rates are going to come down as low as they've been pre a year or 15 months ago, or do you think they're going to stabilise somewhere around about the 2% as well? Because I mean, they were when they were at 0.5, 0.75, you could argue that was, artificially low. It was too low. In fact, some would argue. Do you think we're going to stabilise at a couple of percent?
At a couple of percent, I think it's going to be difficult. When we speak to our managers, they're more of the view that inflation is going to be higher, around 3% maybe, because there's structural dynamics taking place. So a couple of examples, the demand for labour is still very high. Also, companies are reshoring, so taking their businesses out of, say, China and bring it on board, and that increases costs, and so they have to factor that in. You've still got the dynamic taking place within Russia and Ukraine, and that's going to keep the risk to the upside on energy prices. So just a number of factors means that inflation is going to probably sit slightly above where central banks actually target, and therefore interest rates will have to account for that. And so it's unlikely that we'll go back to where we were pre-COVID.
But hopefully lower than where we are now. From a borrower's point of view, from a saver's point of view, you want it to stay high.
That's the thing, as well, along with the decision of the interest rates by the MPC, you also get the minutes and the projections on there. And what we saw in the projections is they do see an environment, if you look sort of 12, 18, 24 months out from now, where inflation does start to come down towards that target level, and that gives them the flexibility potentially to bring interest rates down at that point. I mean, we're not going back to an environment in terms of what we're looking at now of where we've been with rates, but it's interest rates moderating.
And I think when you look at the products that we do and we offer, you look at long-term products, especially pensions, you have to take that medium to long-term outlook view.
Totally.
And the market thinks in the same way. The market's forward-looking, so we've seen an interest rate decision this week, but we've been talking about where the potential peak of interest rates could be, or where do we get to for 6 months, 12 months, 18 months. I feel like we've been talking about forever. And
that can often be very good time for risk assets. So when we look at analysis, what happens when the Federal Reserve pause on interest rates? What can be the returns from equities, from bonds, from gold? It can typically be very strong. Not always, but the data does support that going back over time. And so that is the opportunity cost that you giving up by not investing.
I mean, is this, you're the experts, you tell me in layman's terms, in my layman's terms, whether I'm right on this, because every time I see the Fed in America put up interest rates, you see companies, you see stocks, you see the indexes over there to take a bit of a hit, and I assume that's because borrowing costs, what those rising rates mean is that company borrowing costs are going to go up, therefore there's less profit in them. So obviously right now that means you could be getting in a bit of a discount if you were buying up, if you're buying into the portfolios, for example, you're getting them potentially at a cheaper rate. But if interest rates are going to come down, that's going to be a big boost to the market, because those borrowing costs of businesses should go down. So therefore, the market we hope is going to see a nice bounce as over the next year or so.
Exactly.
Interest rates hopefully come down. So in other words, it's a great time to get into the market if you haven't, or you've been pondering it for a while. Should I? Shouldn't I? Are you getting in at a discount if you do it now, with potentially some good news to come later?
To an extent. Very much so. So if we look at, say, the US market, it was coming into 2022 last year, the valuations of the US market was very, very, very rich, and that has been supported by very low interest rates. We've seen a normalization or correction of that. The US market last year was one of the weakest markets because interest rates had gone up so aggressively. So as they come back down, to your point, yes, it's because markets are forward-looking, the environment should become more favourable.
And Neil, if people want to, let's just say they listen to what Paul's just said there, and George as well, and they're thinking, all right, I'm gonna get into this market. I'm gonna maybe start my investing journey, or I've been investing for a while, but I'm gonna really sort of think about the medium to long term and maybe put a bit more in. How can they do that? How can people open up a TP account or top up the one that they've got?
Very easily via the app or the client site. What we have seen with our advisors over the last month is particularly that the rise in regular investing. So a lot of people are setting up regular rather than putting a lump sum.
Like a direct debit, or just doing it themselves regularly? Or?
Yeah, so direct debit straight into the TP portfolio. You open it up and then you set up a regular. Takes it straight away from your bank account or your debit card. You've also got the impulse save feature as well. So if you maybe set up yourself a £50 or £100 a month direct debit, but then add spare cash, £500, £600, you can press a button and put that in, and it'll buy the units at that cost. And we've talked about pound cost averaging as well, with the market being particularly low and a good time to get in. So it's a perfect opportunity at this moment. But like I said, we have had a lot of increases in regular investing, which is great for a lot of people.
Why do you think that is? Do you think that's is that for the reasons we're discussing, or is there something else going on, do you think?
No, I don't think so. I think it's always something that we've offered clients who have got that spare cash, because if it's there, it's sat in the bank. But also as well, I think obviously there's a lot of people who might not want to take the risk of putting a lump sum in and seeing that bigger fluctuation in the increase in the value, and maybe want to take it on a monthly basis where they go, well, I'm going to treat this like a bill. Do
you think it's also the fact that technology is now making it so easy? I mean, it has here for years and years, but just generally in the public, it's become, we're so used now to just put a photo and it's on your Instagram account, order it, you see something on Amazon and it's there tomorrow. We're very much used to just clicking off we go, and at TP we've been doing that for years. But you can in 30 seconds we could do it now, all of us. You could have money into your account and on its way into the markets. You could impulse save that in seconds, couldn't you?
Yeah, it's a great benefit of obviously something that we've had for a while, but we're probably a bit guilty of not talking about it too much because we.
Well, go on, now's your moment, Neil. You tell us all about it.
Well, we live and breathe it every day, don't we? So we sort of take it as the norm. But yeah, I mean, an easier way to invest is everything is done now. It is by your mobile. If you want to order an Uber in town and you get a taxi straight away, everything is done by a mobile, and it's very, very simple to do via the app. You set up your debit card, you pick in your investment portfolio according to your risk, you set your goal, which is really important, and your product, your ISA or your pension, and then it's tied to your debit card. So what's easier? You click a button, it impulse saves straight into your account and buys the units at that time.
I think it's just the speed as well that if I've got spare 50 quid at the end of the month, I'll get that into the portfolios, and I know it's going to get action straight away.
Well, to Neil's point, there's a strong argument to say do it at the beginning of the month. When you get paid, as you say, treat it like a direct debit, treat it like your other bills that go out. Just get it into the markets and done, and then forget about it. You can worry about it next month.
Well, I think we said it on last week's podcast. I think Greg was pay yourself first, which is a big point.
That's a good point. Just coming back to then, you mentioned the US before George talked. So inflation in the US, you were saying is lower than it is in the UK.
Yep.
So, but nonetheless, it's not as if high inflation and interest rate rises are just a UK problem. We're not alone in the world in this.
No.
This is this genuinely a global phenomenon? But if it is lower in other countries like the US, why is it not that low here?
It is. It's a global phenomenon in the sense, even areas which have gone years and decades without inflation, like Japan, have now got inflation, and they're having to adjust policies which have been firmly in place in order to deal with that. Why is it a global aspect? Is because you've had interest rates at such low levels. You've had consumers locked in the house, and then you've had this the gates opened, and there's a big surge in demand, and people desperate to get out. Businesses are still seeing that demand and are holding on to workers, which is keeping money in employees' pockets and getting them out spending. So you've got this almost cycle which is sort of self-fulfilling, and unless you get a circuit breaker, then it becomes a challenge, and the circuit breaker or the brakes in this case are the central banks. And central banks can manage demand because they can change your borrowing costs, they can change the cost of your mortgage and your car finance and slow the amount which you spend in restaurants and pubs. Otherwise, what they can't really do is influence, how much oil's being pumped into the market or how quickly you get, the supply of semiconductors from, South Korea to the UK. So it's a demand-driven concept, and it takes time to come through, and that's why they had to act aggressively, because actually the inflation which we saw come through was much more powerful, and it was propelled. We knew inflation was coming, but it was propelled through the invasion of Ukraine and what that did to energy supply, natural gas, oil prices, also food prices as well.
So presumably, therefore, those countries that had their own energy supply or had invested in things like nuclear and stuff over years,
the US
were sitting pretty,
example,
and hence why inflation, as you say, is lower in the US. But what the problem Britain's had, if I'm right, I mean, you tell me, is that we haven't got, if you like, the same reserves or the ability to produce our own energy in the way that other countries have.
That's right.
And as you read on the news, for various different reasons, we haven't invested in enough either in things like nuclear or renewables or whatever. So we're a bit of a sitting duck in that respect, aren't we? Having to import energy. Is that it?
Yeah, we're a big importer of energy, and like the US, who've got a lot more self-sufficient in respect of what they've got with shale, and therefore what we saw last year was the big spike up in energy prices. That was a bigger impact to us in the UK and Europe than it was in the US. Now, what does that mean as we look forward? Well, Paul mentioned base effects in the calculation of capturing a year-over-year change. If we move into the second half of this year, we actually think that we'll start to see inflation print in the UK come down because that rate of change year over year starts to reduce. We've seen energy prices which have been coming down, natural gas prices have fallen materially, but also there's base effects. So the outlook in terms of inflation for the UK, we believe we can see an environment this year where we do see inflation at a headline level start to ease.
Yeah, I mean, I'm glad we're making the point that this is not just a UK thing, because I'm not sure that message gets told to the public. I mean, I was listening to an advert on the radio the other day. How it got signed off, I've got no idea, and it was about the UK being in recession. And I remember I've heard people just in the shopping centres in the queue, talking about recession. We're not in recession,
So we had to print that this morning.
We shouldn't talk ourselves down as if we are. This is a global phenomenon. There are reasons why it's perhaps a bit more pointy in the UK, which we've discussed. But this is happening in every country. High interest rates and mortgage costs going up. This is not just a UK thing. And we don't want to tell ourselves that it is.
We had the Bank of England yesterday. They gave their forecasts for the next couple of years on the UK economy. Previously, in February, they were expecting a recession to come. They actually revised up their forecasts. Now are expecting modest growth over the next couple of years. The UK economy, as we've been looking at in the data, has been performing better than expected.
Yeah, but we do need the economy to grow. And this is one of the challenges, isn't it, Neil, that you've got on the one hand, in terms of households, you've got a so-called cost of living, rising pressures on people's wages, which are then going up, which is also then fueling inflation, because as people battle with general prices in the shops, they're demanding higher wages. Some of that's feeding through higher inflation. On it goes. But if you're a business as well, thinking about investing in your company over the next 6 to 12 months, if interest rates are going to potentially keep going up or they're this high, you've just got no idea what's going to happen. It's really hard for a business to think, well, I'm not sure whether I might just have to sit on my hands for 6 months. I'm not quite sure whether to invest because my borrowing costs could be much higher or maybe not. So I'll just sit tight.
Yeah.
Which is then, therefore, if lots of companies come to that view, that's going to stunt growth. So there's a lot of different. It seems to me a lot of things working against each other.
Yeah,
policies working against each other in the UK.
Well, I think it's also to do with the individuals as well. We've got the centralised clients who we obviously have 60,000 clients that we service in the UK, and I think a lot of people are maybe sitting on the finances at this moment. The maybes are mortgage payments have gone up. The maybes think, well, I need to cut back on this, but at that point, it's always good to have a financial review. And that's what we're doing. And people tend to do it at the start of the tax year, and that's why we're really busy at the moment doing things like annual suitability reviews, and also as well the rise in mortgage payments, or maybe it's encouraging people to look at how much money they're taking out of their pension and to maybe increase that just to cover the additional cost. But it's always good to have a review, and that's what we're really busy at doing.
And always worth speaking to your advisor as well. I mean, right now there's a lot of, as we say, there's a lot of things bubbling away in the economy that are affecting people in different ways, whether you're a saver, whether you're a borrower. Typically people might be both. So it's always a good idea, as you say, to have a chat with your advisor or the team here.
A lot of people don't realise, and myself included, and probably everybody in this room, is when you look at your banking app and you look at the amount of money that you've got going out, you're thinking, crikey, I'm spending a lot of ad hoc spends here. £7 Sainsbury's, £11, M&S, whatever it may be. And you're thinking, I'll have a financial review because I can see realistically where I'm wasting a lot of money. And it's always good to have that, because when you do look at your income and expenditure, you'll probably find that without ad hoc spending, you've got a lot more net disposable income at the start of the month than what you think you have. So it's always good to have a review.
Absolutely, yeah.
Just in terms of what we're doing in the portfolios, you made a good point about this isn't a UK standalone situation in terms of inflation. That likewise, we're not restricted to investing in the UK, so we can invest clients' money in parts of the market where we believe there's a better opportunity, and therefore one of the areas which we've been building through the course of this year has been government bonds, because Paul mentioned the expected return for that asset class looks better. An area where we've been focusing is in the US. If we look at what we've been doing in our portfolios and what Paul's been doing in his fund, he's been building exposure which has been rewarded in terms of the return delivered. And that's of a view that if interest rates do come down, it's a much better environment for that asset. But if inflation remains a challenge and interest rates are coming down, we've been diversifying the way we access that by using inflation-linked bonds as well. So multi-asset is all about looking at all of these challenges and saying, okay, well, how do we navigate these and where are the opportunities? So we're talking about, live prints or relatively live prints. They're backward looking, but we're just getting them this week. But we've been talking about these subjects for a long time and investing clients' money accordingly.
And I think that diversification point that George makes, Paul, is a really important one that, again, for people who are perhaps new to the podcast or new to True Potential, all our eggs, or your eggs when you invest with us, are not in one basket. The absolute opposite of eggs in one basket. So talk a bit about how we do that, why we do that.
Yeah, we really focused on the concept called advanced diversification, and it's looking at diversification through different lenses. So we look at it, we use different managers with different styles. So some might be stock pickers with a value style, or someone might be fund of funds. So that's one layer of diversification. We also invest globally across different regions, so you get diversification in there. So we talked about UK inflation, big problem here, less of a problem in the US. So we want to be diversified there. And then we look at different asset classes. So we're not only investing in stocks and bonds, but we're also investing in alternative assets, investing in gold. All perform very differently, and it helps really smooth the journey for the end client in terms of the returns and the volatility they receive, and really trying to get strong returns but minimize the volatility for them.
Yeah. So someone who does what Neil says, opens up their True Potential account, does that direct debit, that £100, 150 quid, whatever it might be a month, that's getting spread across the world.
Exactly.
And so you're getting a bit of the uptick in America when that comes. If it comes, you're getting some, as you say, some alternative assets. You're getting a bit of UK, but you're getting a big spread.
And you're getting different managers as well. You're getting 10 different managers. These are world-class managers.
Yeah.
And you can
like
who
when you say managers, who are we talking about?
So these are big companies, the likes of Goldman Sachs, SEI, Allianz, known all around
Household
the world.
names, basically.
Household names, absolutely.
Yeah. Okay. Good. Well, there you go. So one tip then to beat inflation, or to over the long to medium term, I'm talking about here. So what would you say to somebody watching this podcast today, thinking, okay, I know interest rates are high, and maybe you are lucky right now getting something like you say 3% in the bank, but over the long term that's unlikely to hold. What would be your advice to somebody, or your best tip to somebody who's thinking, I really need a kind of 5-year plan here? What should it be?
Mine would be to have a review with an advisor. We always recommend that. Normally every 12 months to review your current investments, but also your personal situation as well. And also think about the medium to long term. Don't think about the short term effect of the market, because that's where you want to be looking at to achieve your goal.
I mean, that 7, the 3% we talked about you might be getting in the bank. I mean, we've got True Insight there, and there's a new one coming out in the next week or so, which has got the data in that your portfolios have performed going back to 2015.
Yep.
And I believe correct me if I'm wrong, but I know because I'm in the aggressive portfolio, And I think after fees, that's delivered annualised about 7% growth.
Yeah, about
over the
7.3% growth on an annualised
after
basis.
fees. And that's going back to 2015.
Yeah.
Now that's there's real growth over the long term.
Yeah.
Historically, well above inflation.
Yeah.
Whereas these bank accounts might be maybe a friend right now, but let's see what they're doing in 12 months' time.
But also got to think over that period. Think about the number of events that we've all been concerned about:
true.
inflation,
True.
COVID, Russia, banking issues.
Mm.
We've still been able to deliver those returns. So yes, it can be uncertain at time, but have faith in the people that you invested with, the advisors that you speak with.
Keep the faith. It's a good song as well. Excellent. Good time to end. Right. Thank you very much, Paul, George, and Neil. Some useful, I hope, discussion there around interest rates and what's happening, why it's happening, and as Neil was saying, what you can do personally about it as well. So thank you very much, and thank you for watching. Hope that's been useful. If it has, and even if it hasn't, still give us a like and a subscribe, because we like that. And tune in again next week, because we do this each week on the podcast. We try to get into the detail of what's happening in the market and how it affects you. So do give us that like, hit subscribe. Thank you for watching, and we'll see you next time.